Hello, ladies and gentlemen. Thank you for standing by and taking the time to join us for today's webcast, PPP Loan Forgiveness. During the presentation, all participants will be in a listen-only mode. Please use the question feature to submit your questions, which will be addressed during and at the end of the presentation. Without further delay, Steve, can you get us started?
Yes. On behalf of Banner Bank and CliftonLarsonAllen, I would like to welcome all of you and thank you for joining us today. I've been told that we have 365 people that have registered for this, and I want to thank you. Most of you are clients, and to those, I'd like to thank you for your business. These have been some uncertain times, and they've created a lot of anxiety, and I hope that Banner and our employees have helped you guide through this period. Hosting events like this are important in earning and retaining your business. And we are grateful that CliftonLarsonAllen has agreed to participate and share their expertise. They've become experts of everything PPP. And we do consider them experts as the topic continues to evolve. As you all know, we started this journey back in April when PPP was announced. We did experience some bumps along the way. It was like building an aircraft while it was in flight. And we thank you for your patience. We cross-trained over 170 employees, and we expanded our SBA department from 13 people to nearly 200 during this period. And many of these employees that you work directly with worked countless hours late in the evening to process your requests, and I want to thank them and thank you for your patience during that process. To date, we've approved 8,500 applications and have funded over $1.1 billion in PPP loans. We're now in the forgiveness phase of the program. You will be contacted by email on how we will manage this forgiveness process. We are developing an electronic portal that will be interfacing with the original SBA application. And in the upcoming weeks, you will be notified on how that process will be managed. We're busy incorporating some of the recent rules, so we want to make sure that we have all the updates. As you prepare, we encourage you to reach out to CliftonLarsonAllen and to answer any of your questions. And without further ado, I'd like to introduce Jack Rybicki. He's a managing principal in the firm out of the Tampa Bay, Florida office, and he has 27 years experience in audit and consulting. Randy Wells is managing principal in the firm's Southern California office and is also principal in charge of transaction services and the private equity groups for the Western region. He has over 28 years experience. Ted Mueller is the Chief Financial Officer for CLA's outsourced accounting department in California. Ted has over 30 years of public and private accounting experience and experience in startups, emerging markets, and middle market. With that, I'd like to kick it over to Randy for some further comments. Yeah. Randy, all yours.
All right, thank you, Steve. Really appreciate it. CLA values the partnership with Banner Bank and the opportunity today to present to your clients. Welcome, everybody. For those of you who don't know CLA, we're among the nation's leading professional services firm. We're a top 10 firm, actually number 8, with over 120 locations in the US, more than 6,500 people. This includes 8 offices in California and over 500 people in California. And as Steve mentioned, I'm the managing principal for our offices in Southern California. We bring a seamless integrated approach to serving clients in a variety of industries. And for a national firm, it's somewhat unique. We're really focused on serving the privately held businesses and their owners, as well as many nonprofit and governmental entities. Again, Steve, we appreciate Banner having us. I know you guys are going to enjoy and learn a lot from the presentation from Jack. So with further ado, I will turn it over to Jack Rybicki. Jack, it's all yours.
Great. Randy, thanks so much, and Steve, thanks again for that gracious introduction and for allowing us to speak with your bank's customers. So today we're going to focus mainly on PPP loan forgiveness. We've got quite a bit. All the guidance that came out over the last probably, I would say, 3 to 4 weeks following the PPP Flexibility Act that came out as well. And there really hasn't been too much that's come out in the last couple weeks. I will cover that, anecdotally. And I do want to say I appreciate we've gotten a number of questions even before the presentation started. We got questions around, how the FTE safe harbor works, how the covered period works and the alternative payroll covered period, bonuses, state taxes, a number of those things. I can assure you that a lot of that is going to be covered in our presentation today. We do have a lot to go over. There was one question that came in though that related to the EIDL program, right, or the Emergency Injury Disaster Loan Program. And because that's not covered in the presentation, I thought I would just hit that one right out of the gate before we got into the presentation today. So the EIDL program is a completely different program for the PPP. However, while the PPP program was administered through the banks that worked with the SBA, the EIDL program is administered directly with the Small Business Administration. And so the question that came in is, how do I apply for that? Applications are now being accepted, is our understanding. They were on hold for a while, but we believe you can now apply through the SBA's website, so sba.gov, and you can go out there. The maximum EIDL loan amount currently is $150,000. That's been set by the SBA itself, not any other statutory body, and there is pressure to increase that. But that program is out there, and it is another alternative. The EIDL and the PPP were meant to work together. The one thing is that you cannot use the dollars to pay the same cost. So you do have to be careful if you get the EIDL loan that you don't, pay the same things that you paid with the forgivable PPP dollars. So hopefully that answered the question on the EIDL that had come in. We will talk about how the EIDL emergency grant plays into forgiveness as we get into the presentation. So I do want to just add though that our attorneys tell us that we've got to add this because we're not an attorney. CLA is a professional services firm. We focus a lot on the accounting side of things, and we're just trying to interpret the rules as they come out. So the guidance, as you all know, on this program changes on a fairly regular basis. We have, updated this presentation with the guidance that came out through the holiday. But I would encourage you, if you're looking for definitive answers, although most law firms aren't going to give you those either, you should definitely consult with not only your accountant, but your attorney, on anything that's legal, and interpretations. So we're going to get into the forgiveness calculation, but before we do, I'll just cover, what's happened in the last roughly 2 weeks. So the program itself was set to expire on June 30th, and actually did expire June 30th. However, before Congress went on recess, they did pass an extension, and the president did sign that extension, basically reinitiating the SBA's authority to issue new loans under the PPP. So that program is now extended out through August 8th, and so that is for the initiation of new loans. However, some of the topics that were being discussed, like allowing certain borrowers to get additional loans under the PPP or apply for a second PPP loan, none of that was included in this extension. It was merely an extension of time for the SBA to approve loans. There's roughly about $130 billion left in the program that was allocated that has not been requested yet by borrowers. So there is money out there for folks that have not applied yet. Nothing really new since June 22nd, though, in terms of developments related to forgiveness or anything like that. And so all of those guidance that we had received are now incorporated into this presentation. So we're going to start with some PPP basics, and we're going to talk about what's eligible for forgiveness. And there's really a few main components, right? You've got the nature of the costs that are eligible for forgiveness, and those we're going to divide into two buckets, your payroll costs and your non-payroll costs. But then there's an underpinning for this about on what's eligible in your covered period. And there's a lot of questions about what is your covered period, because that was originally 8 weeks, now it's 24 weeks. So there's a lot of discussion to unpack there. So I'm going to start with unpacking the covered period discussion, but then we'll get back into payroll costs and then non-payroll costs as well. So for the covered period, those of you that received the loans in kind of that April and May timeframe, you'll remember that the original covered period was an 8-week covered period. So the thought was that once you received your loan, so the day you received your loan was the day the covered period started, you had 8 weeks to use that loan, and then whatever you used in that 8 weeks, you could request forgiveness for. Now, with the PPP Flexibility Act that came out and it was ultimately signed into law on June 5th, that covered period, the 8-week covered period, went away effectively. And all loans now have a 24-week covered period. However, for borrowers that had loans in place before June 5th, you can still elect to use the original 8-week covered period if you would like to. And so we get a lot of questions about this. What do I have to do to elect for the 24-week period? There's nothing you need to do to elect for that. It's automatic. It's part of the new application that came out on June 16th. And you just have to use that new application now. So there's nothing you need to do as a result of the legislation to elect that. Same goes with the 8-week period. Really, you will elect the 8-week period, but you'll do that when you apply for loan forgiveness using the application. And so from that perspective, there's no separate thing you need to do to elect the 8-week period. Nothing you need to qualify for to use either one of these. The only difference is if your loan came on after June 5th, so after the Flexibility Act, you only have a 24-week covered period. You don't have access to that 8-week original covered period. However, the whole 24-week period did become somewhat of a moot point because we got some guidance on June 22nd where the SBA has said that a borrower can now file for loan forgiveness before the end of your 24-week period. And we'll talk a little bit more about how that process will work later on in the presentation. But it does appear now, based on what the limited guidance we've got, that let's say you're 13 weeks into your loan period, you've used all of the loan proceeds on eligible costs and you're going to get 100% forgiveness. At that point in time, you could then apply for loan forgiveness. You do not have to wait till the end of the 24 weeks. Now, we haven't gotten a lot of guidance on how that's going to be applied, though. And so, we're recommending to our clients at this point that they hold off on forgiveness applications if they're not going to use the original 8-week period, because we need some guidance on how to apply things like the wage reduction test or the FTE reduction test, if there is one. Now, if you're going to file using the new form 3508EZ, and we'll talk about the requirements for that form shortly, then you can move forward with that application process as well. Although, as Steve mentioned earlier, most banks are still in the process of pulling together their portal and how they're going to accept information. And the SBA still has not made guidance available to the banks on how the information will get transmitted from the bank to the SBA. So you really can't expedite the forgiveness process right now anyway, because the whole system's not set up there. So there is some planning to be done in the covered period, though, particularly as it relates to your payroll costs. And we're going to get into payroll costs now, and then some of the nuances related to that. So on this slide, it really talks about the different periods that are out there from a covered period perspective. You've got either your original 8 weeks or your 24-week covered period, but there is an option for what's called an alternative payroll covered period. And that period is there for folks that use either weekly or bi-weekly payrolls, right? And the thought was that because you have either an 8-week or a 24-week period, if you pay once a week or once every 2 weeks, you could effectively align your payroll periods with your covered period. But chances are your funding date didn't fall on one of those dates. And so for an administrative convenience perspective, they created this alternative payroll covered period. And that's all it really is. It's still either an 8-week or a 24-week period. But for your payroll related costs, you can choose to accumulate those during a different period than your normal covered period. Now, your normal covered period is always going to apply, though, to your non-payroll costs. So things like rent, utilities, interest on mortgage obligations, those are always going to be during the normal covered period. That is either the 8-week or the 24-week period following the funding of your loan. It's only payroll costs, and I mean all payroll costs, that really get applied that alternative payroll covered period if you elect it. Now, if you have a semi-monthly or monthly payroll, you don't get the opportunity to elect an alternative payroll covered period because those pay periods are never going to correspond neatly to either an 8-week or a 24-week option. And as a result of that, you don't get any administrative convenience because you're going to have to do some prorating on the front and the back. And so as a result, you cannot use an alternative payroll covered period if you're not that weekly or bi-weekly filer. So for payroll costs, and I'll just refresh here back at, what's included in payroll costs. You've got the salaries and wage component. You'll hear that referred to quite often as the cash component of payroll costs. But then you have 3 other components that are part of payroll costs as well: group healthcare benefits, retirement benefits, and then the employer portion of state and local payroll taxes. And so that's what we're gonna be talking about in these next couple slides, is just the payroll cost component. And so we did get some guidance, as the application came out as to how and what you will be able to include in payroll. And so the guidance originally was very unclear. We were not sure if payroll had to be both incurred and paid during the period, if it was only going to be what was paid during the period, so you'd lose maybe something on the back end. But what we got was very liberal guidance that came out from the SBA. And so basically, if your payroll is either paid during the covered period or the alternative payroll covered period, whichever one you choose. And for those of you that are looking at the slides, the CP makes reference to the covered period, and the alternative payroll covered period is what's the APCP. So if you do hear me refer to those acronyms or see them, that's what those relate to. And so during the covered period or the APCP, if you pay your payroll, it is includable and eligible for forgiveness. Also, though, on the back end, if you incur the payroll during your covered period, but don't pay it during the covered period, but pay it immediately after in the next normal payroll cycle, then that is also includable. Now, for companies that pay a week in arrears, what this means is that generally speaking, you're going to either include 9 weeks or 10 weeks worth of payroll in your payroll costs for what is eligible for forgiveness, because usually your covered period is going to start and you're going to have at least one payroll that you're going to pay after the beginning of your covered period that relates to a time period before you received the loan. However, because it was paid after you received the loan, you will be able to include that in your costs that are eligible for forgiveness. And so, again, we think that this opens up the 8-week period to a lot of people to be able to file, because now you could, in theory, have, let's say, 10 weeks worth of payroll included in that 8-week covered period with this application of the rules that were provided. Now, on the flip side of that, non-cash payroll costs, so again, the healthcare, retirements, and then the employer portion of state taxes, those do have to be actually paid during the covered period. So there's no prorating of those or anything like that. Those are based on what was actually paid during that covered period or alternative payroll covered period. Now, we may get some more guidance out that gives us some flexibility there, but based on the application, our reading currently is that those have to be paid during that period of time in order for them to be eligible. And we're going to go into the healthcare and retirement payments in a little more detail shortly. The one thing we get a lot of questions on, and I do want to make sure we cover it, is the maximum allowable eligible costs, right? And so again, that cash compensation, we know that the government was trying to protect employees that were making less than $100,000. And so as a result of that, they basically capped your eligibility for forgiveness at $100,000 prorated for your covered period. So for an 8-week covered period, that number was $15,385. So that would be the most you could claim for one employee that would have been eligible for forgiveness. So it's not to say you couldn't pay somebody more than $100,000, but if you had paid them, let's say $20,000 during the 8-week period, only $15,385 would have been eligible for forgiveness. Now, for employees, and I'm going to distinguish between employees and owners, for non-owner employees, during the 24-week period, you can actually get $46,000 per employee eligible for forgiveness. And so what this allows you to do is you may not be able to bring back your workforce because you don't need all of them. However, if you have a lower number of employees, because you now are collecting their payroll for a 24-week period, you still may be able to get to 100% forgiveness because on an individual employee by employee basis, the maximum is now $46,000 for that 24-week period. Now, what we don't know is what happens if you file for forgiveness after, let's say, 13 weeks, right? 13 weeks out of 52 would be roughly 25%. Prorated would only be $25,000. So that's one of those questions we have on implementation that we don't know the answer to yet, is what happens on the maximum per employee if you file at some period of time less than 24 weeks, but more than 8 weeks. And so we're looking for guidance on that. Now, the numbers I gave you, the $15,385 and the $46,000, those relate specifically to non-owner employees. And so that is based on what you paid them during the covered period or the alternative covered period. Owners get treated very differently. So owners are, for S corporations and C corporations, it's based on W-2 income. However, it's based on their 2019 wages. And the reason the SBA did this is they didn't want owners that previously were not paying themselves, or maybe were paying themselves a lower level, to give themselves raises during the covered period and take some of the benefit away from the other employees that were there for the company. And so as a result of that, they look at owners, and they always make owners look back at 2019 in order to determine the amount of wages that are includable. So again, if you're an S corporation owner or a C corporation owner, you look back at your 2019 W-2. For an 8-week period, you would be also limited to that 15,385, assuming you made more than 100,000, or whatever prorated number would be. Now, for the 24-week period, though, owners are limited not to the 24.50 that employees are. They are limited to 20,833, which is 2.5 months of your 2019 amount, subject to that $100,000 max. The reasoning that the SBA did this is they said that was how your loan was sized related to owners, and that's why that's the maximum benefit that owners can get under the program. So the extension of the 24-week period allows you to give a bigger benefit to non-owner employees, but it does cap the owner piece at $20,833 per owner, assuming they made $100,000 in the prior year. Now, if you were a Schedule C filer, you have to look back at your 2019 Schedule C, line 21 specifically on that. Or if you're a general partner, so if you work in a partnership or an LLC taxed as a partnership, but you're an active general partner or limited partner in the business, then you would use your K-1 income. But there are some adjustments that you'll have to make for that as well, for the employer portion of taxes that you also have to pay, unreimbursed business expenses. So the K-1 rules do get a little more complicated, but you still do have those limits of 15,000 and 20,833 for those two periods. So hopefully that demystifies a little bit on the cash compensation piece. Now, we did have a question that came in prior to the presentation that asked about bonuses, and we did get clarification that bonuses or other things like hazard pay, so things that were not part of normal life back prior to COVID in terms of hazard pay, those are includable in the cash compensation piece, obviously subject to the limitations that we have here on what's allowable. So I did want to just highlight that to make sure we were responding to those questions. So now I mentioned there's some non-cash components, and when I say non-cash, it's not that they don't cost the company anything, it's just that they're not paid to the employees. And so healthcare and retirement have some unique rules, again, depending on whether it's an employee or an owner. And then even within owners, things get treated differently. So we're going to go through those very quickly now. So for an employee, there is no limitation on health and retirement. So whatever the company pays for healthcare or retirement benefits for the employee is includable and is eligible for forgiveness. Now, it has to be paid during the covered period, as I mentioned earlier, and it's only the employer portion of that. So for instance, I think we had one example that I went through in one of the questions that came up that they pay 50% of the health insurance premium, and the employees pay the other 50%. So let's take an example of a $20,000 health insurance premium that was paid during the covered period. 10,000 of that would have been withheld from employees' paychecks, and so the net out of pocket related to that premium would have been $10,000. In that case, that 10,000 that was paid net by the employer would be the piece that would be eligible for forgiveness. Same thing with retirement contributions. It's not the gross contribution to the retirement plan, it's only the employer portion of the retirement contribution. And again, that's for employees. And it doesn't matter whether an employee makes more or less than $100,000, you can include healthcare and retirement for those employees as eligible forgivable costs. Now we're going to go to the owners quickly because they have different rules. So for self-employed individuals, so if you're a Schedule C filer or general partners in a partnership, unfortunately, any health benefits or retirement benefits that the company pays on your behalf, those are not includable in what is eligible for forgiveness. However, for owner employees, and this is those folks that are included for C corporations and S corporations, health insurance is includable for both, or for C corporation owners, but it is not includable for S corporation owners. Now, retirement plan contributions are includable for both, but they are capped at the 2019 contributional limits. And again, using that same 8 weeks for an 8-week filer, or 2.5 months if you're going to use 24 weeks for those contributions. So retirement is okay for S Corp and C Corps, not for self-employed and general partners. For healthcare, only for C Corps can it be included, not for S Corps, not for self-employed, not for general partners. And I know those rules are a little complicated, but they are laid out in the application and the instructions itself. So I'd encourage you to look at those if you have questions, or reach out for help applying those rules. So here's some payroll questions that we get that are, some of them are clarified and some of them aren't. And so I just wanted to go through those before we move to the non-payroll costs. So I mentioned earlier, bonuses and hazard pay are eligible for forgiveness. I also mentioned that, amounts that were paid during the covered period, but maybe sometime incurred prior to the covered period, are also eligible for forgiveness. However, it's unclear how liberal you can be with that, right? So my example was, you might have a payroll that gets paid a week in arrears. We think that that is clearly includable in the eligible cost for forgiveness. However, let's take a different example where maybe on March 1st you decided we're gonna cut people's pay by 25%, and we're gonna defer that, and hopefully we can pay you that at some point in time in the future. So it was more of a furlough of payroll rather than a reduction. And then when you got your PPP loan, maybe you paid all of that back pay from, let's say, March 1st through your loan date of April 20th. In that case, we're not sure if all of that deferred comp is going to be eligible. Conversely, we know a lot of folks, because they started to see the signs that COVID was going to impact their business, they may have accrued bonuses in 2019 or retirement plan contributions, but maybe hadn't paid those yet, and so they still haven't paid those. Again, we don't know if those got paid during the covered period, if those would be eligible for forgiveness or not. We hope to get guidance out on that, but we have no clear guidance on whether or not things that were that far in arrears would be eligible for forgiveness. On healthcare benefits, we get quite a bit of questions about what constitutes health benefits and what if I have a self-insured plan. And so we are confident that payments made during the covered period into a self-insured plan are includable as an eligible cost for forgiveness. But again, they have to be made by the company into the plan, and they can only be paying current costs. Now, healthcare benefits, have a big, broad title. We know that things like healthcare, vision, dental are includable, right? We get a lot of questions about what about things like life insurance benefits we provide, or short-term disability, long-term disability. Those types of benefits, the short-term, long-term, and life, those are income continuation benefits. And while they're often looked at as part of the employee benefit package, they are differentiated by the IRS as something other than healthcare benefits. And so we believe that the costs of those types of benefits, the short-term, long-term, and life, are not includable or eligible for forgiveness, but premiums you pay for vision, dental, mental health programs, obviously medical, those are the types that are includable as eligible healthcare benefits if paid for by the company. So hopefully that clears up some of the payroll questions that are out there. We're now going to move to the non-payroll bucket. And the reason that we differentiate these two has to do with the forgiveness calculations that we're going to go over in just a minute, because you have to use a certain percentage of the amount that you request forgiveness on for payroll related costs. And therefore there's limits on what you can request forgiveness for related to these non-payroll costs. And while we have 4 non-payroll costs here, because these are all of the eligible costs that you can use PPP funds for, unfortunately, only the first 3, the interest on mortgage obligations, rent, and utilities, are eligible for forgiveness. So this last bar, this interest on other debt obligations, while you can use PPP proceeds to pay that interest, you cannot request forgiveness for that amount. And think about it, that would be things like automobile loans, unsecured lines of credit, working capital loans that you've got, or asset-backed loans that are based on, let's say, receivables and inventory. All of those would be non-mortgage debt, and as a result of that, the interest on those is not subject to forgiveness. So only interest on your mortgage for your real property and the internal personal property is includable. So we're going to go through some of the common questions we got related to payroll costs. So we did get that same kind of concept of if it was incurred during the period but paid immediately after the covered period, that is includable in what is eligible for payroll costs. If you think about your normal utility bill, let's just say the end of your covered period was June 30th for sake of discussion. Well, you might get a bill for utilities through the end of June 30th, but you're not going to get that bill until, let's say, July 7th, and you might not pay it until July 22nd. So now, well outside your covered period. Again, to the extent that the bill is during the covered period, you can accrue a portion of that bill or all of it as long as it gets paid in the next normal billing cycle. So if you pay it by its due date, then that does become part of the eligible costs that are subject to forgiveness. Now on the front end, you also get the benefits that I talked about for payroll. So if you pay a bill during the covered period that was related to a prior period, you again get to include that. Now, I mentioned earlier there is limits on what you can deduct for or get forgiveness for non-payroll costs. So the rule used to be that only 25% of your forgiveness could be non-payroll related. However, with the PPP Flexibility Act, that threshold was increased to 40%. So now up to 40% of the forgiveness amount that you request can be for non-payroll related costs. What we're finding though is most people are not having any problems getting to that 60% or more threshold. And in some cases, it's easier just to use all payroll to get your loan forgiveness. In that way, you don't even have to report your non-payroll related costs on your application. Saves you a little time in pulling all that data together. We do get a lot of questions though on non-payroll related items. The biggest one that we probably get is on utilities. So utilities is a big bucket, but it's not clear what's included in that bucket. So what we do know are things like water, electricity are definitely included. Natural gas is definitely included. Telephone is explicitly included as well, but There's a question on telephone. Does that include cell phone service, or is that just traditional landline? There's no specific guidance out there on that yet. However, we believe that if the company is the group that is contracting with the carrier for the cell phone service, so these are company provided cell phones, then it is likely that the cell phone amount would be includable as a utility. I'll contrast that with a plan where you allow your employees to submit for expense reimbursement for personal or for business use of their personal cell phone. In that case, because the company doesn't have the contract with the telephone carrier, as a result of that, you would not be able to include those reimbursements as a utility expense. Now, that's our interpretation. We've heard others interpreting it that all cell phones are includable, and some are saying all cell phones are not includable. We look for more guidance from the SBA on that. Another one that's really hotly discussed is transportation, because utilities in their definition say transportation as a utility is deductible. But nobody that I've talked to seems to have a good idea of what transportation utilities are. And so the question we get a lot is, well, what if I have to buy gas for my fleet? Is gas a utility? And we don't know the answer to that question. We think that would be a very aggressive stance to include gas, which is, used to, maybe in your vehicles or in your construction equipment as part of a utility, because that's a little different than what we see for kind of electricity and other things to keep your headquarters going. Now, the other one that I want to add here is internet is considered a utility as well. I know that that's a cost that a lot of folks are incurring, obviously, nowadays as well. But cable TV, which is more entertainment in nature, is not considered a utility. So I did want to cover a couple other things. Related party rents, we don't have any guidance out there on what or whether or not related party rents are going to be eligible for forgiveness or not. We know that if there was a lease agreement in place as of February 15th, then related party rents at least have a chance of being included. And it should be only included in your calculation based on what you used to pay for rent. So we would not suggest manipulating the related party rent amount, increasing it to get to a higher forgiveness number by paying yourself, for instance. Because the related party rents could be subject to abuse, we do expect to get more guidance out there on that. And I did mention that we believe that interest on things other than mortgages are not includable. There has been some discussion about potentially including that, but none of the guidance to date has made it clear that change is going to happen. So that really kind of covers the costs that are eligible for forgiveness. And so now we're going to get into the forgiveness calculations themselves. And no matter whether you use the easy application form or the long form, you're going to have three numbers that you're going to calculate. And so we're going to go through those three numbers with you pretty quickly because the easy application in particular has no reductions. And so those numbers are pretty easy to determine. We will get into the way the reductions work, but I'm not going to get bogged down in those details because I don't think that a lot of companies are going to have reductions for wages or FTEs based on some of the safe harbors that are out there now. And we are going to go over those in more detail. So I'm going to start in the middle of this slide. And so again, you're going to calculate three different amounts. And the lowest of those three amounts is going to be the amount that you can ask for forgiveness for. One of those amounts, the middle column here, is just your loan amount, right? So you know that you cannot get more forgiveness than the loan amount itself. So that's one of the three numbers. Now the column all the way to the right has to do with the payroll costs as a percentage of the number you're requesting forgiveness for. So I mentioned that payroll costs have to be at least 60% of the costs that you're requesting forgiveness for. Or conversely, there's a 40% limitation on non-payroll costs implied in the forgiveness calculation. So the way to calculate this number is pretty simple as well. You take the payroll costs you incurred and you divide it by 0.6. And so now you've got two of your numbers, right? And so let's just use a $100,000 loan as an example. That would be one number. As long as you spent $60,000 or more on payroll costs, the $100,000 would be your lower of those two numbers. But let's say for some reason you only spent $50,000 in payroll costs, even during the 24-week period. Now, if you took that $50,000 of payroll cost and divided it by 0.6, you would get a number of $83,333. That number now becomes your new maximum forgiveness amount, because that number is lower than your PPP loan amount. So now that's your new max, your $83,333. Now I'm going to go to the first column, which is a little more complicated. Now the EZ form only has the first box on this column because there are no reductions on the EZ form for wages or FTEs, because by doing the EZ form, you're saying you've met one of the safe harbors and wage reductions and FTE reductions are not applicable to you. So box one is basically how much did you spend during the covered period on eligible costs, right? So those things that we just went through in terms of payroll and non-payroll costs, how much did you spend on them? Now, during an 8-week period, maybe you spent something similar to $100,000, which would have been, the original sizing of your loan. However, during a 24-week period, maybe you spent $250,000, even though your loan was only $100,000, because you were using other funds to pay those costs. So you can include more than your loan amount in the amounts that are eligible for forgiveness. And there's some planning around that, because if you do happen to have an FTE reduction, by driving those numbers up for the eligible costs above your loan amount, you still might get to 100% forgiveness. And let me give you just a brief example. Let's just say you did spend $250,000 on the on eligible costs, payroll and non-payroll. Let's just say you continued to pay everybody reasonable wages, but you only brought back 50% of your employees. So you're going to have a 50% reduction in your forgivable costs. Well, when you apply that 50% reduction against the $250,000 you incurred, now you still get left with $125,000 is eligible for forgiveness. Now, if you remember, we had $100,000 as our loan amount, and in this case, our payroll costs are not going to be a limiting factor. So in that example, you would be able to get 100% forgiveness, even though you only brought back 50% of your FTEs. Now, the one thing I do want to point out here, and this gets back to the EIDL loan, if you got an emergency advance, this was up to $10,000, that emergency advance is going to reduce your forgiveness calculation. And so that amount will effectively convert to a PPP loan that you are going to have to pay back. So I'm not sure that was the intent, and we might get something out from Congress on that, but currently that's the way it's being interpreted. So you will be left with something to pay back at the end of the day if you did receive that EIDL emergency advance. So now I'm going to get into kind of boxes 2 and 3 in this first column. Again, we went through box 1 in a lot of detail already on payroll and non-payroll costs, but now we're going to get into how you deal with the did you maintain wages or not, and then we'll get into the FTE test. So the wage reduction test is, we got good news when the application came out there. We learned that you're going to compare what you paid people during the covered period or the alternative payroll covered period with what you paid them in Q1 of 2020. but you're not going to look at the total wages that you paid them. You're actually going to look at the wage rate. So for instance, if you paid somebody a salary of $75,000 and you continued to pay them that same salary of $75,000, there was no reduction. You don't have to worry about it. Conversely, if you had an hourly worker and you used to pay them $20 an hour, and during the covered period you continued to pay them $20 an hour, even though their hours might have been reduced, you're not going to get hurt on the wage reduction test because you still paid them at the same rate of pay, even though their pay may have gone down because they worked less hours. The reason this test works well is because you're already going to get penalized potentially because they're working less hours on the FTE test. And so by using the absolute wage rate, you're not going to get penalized for that same thing twice, right? Now, the wage reduction test only needs to be applied to people that made less than $100,000. So this would be only applicable for folks that were on your payroll during 2019 that made less than $100,000 and were paid during the covered period. And so, those are all positive things. Now, if you did happen to reduce wages and then you reinstated those wages before you applied, so again, let's take an example. You paid somebody $20 an hour, you reduced it to $15, but then you reinstated it to $20 an hour before your application date for forgiveness, then you've met a safe harbor and you no longer have to apply the wage reduction test. Now, the wage reduction test itself already has a little wiggle room in it, right? You can already reduce compensation by up to 25% and not get penalized for it. And so as long as you don't reduce people by more than 25%, you're not going to have to worry about this test. If you did, but you reinstate those wages, you also do not have to worry about this test. Now, the FTE reduction test is probably the more problematic of the two tests because while the wage reduction test is applied at an employee by employee level, we weren't seeing a lot of significant wage reductions. And so the FTE reductions is basically how many of your employees did you retain was the more problematic of the two tests. However, there are two safe harbors now that eliminate the need for the test altogether. The first one is if you didn't have any reduction of either number of employees or average hours paid. And not a lot of people are going to fall into this bucket, but some might. However, there was a new safe harbor that we think is a key one that everybody needs to think about. And this was one of the safe harbors that allows you to use the EZ form. And basically, it's saying that if you were unable to operate at the same level of business activity during the covered period that you were prior to COVID, then you don't have to apply the FTE test. Now, your inability to operate has to be either directly or indirectly related to requirements or guidance that was established by some of these federal agencies out there, HHS, CDC, or OSHA. But we know in California that you had stay-at-home orders and you had numbers of businesses that were determined to be non-essential businesses that were ordered to close. So if you were subject to those non-essential business orders, this safe harbor will eliminate your need to do the FTE reduction test. I want to say that again because it's really important. If you were deemed a non-essential business in the state of California, and as a result of that, you had a decrease in business activity, you do not need to apply the FTE reduction test. And you can likely use the EZ form for applying for forgiveness. So the FTE test, in a nutshell, if you have to use it, you look at your covered period FTEs, you compare that to your benchmark period, which is either the first 2 months of 2020 or February 15th through June 30th of 19. And if you had a reduction, that was not related to closures or other, imposed restrictions, then you would end up having a reduction that you would have to apply. And I did have a couple clients that are going to fall into this bucket just because they could have operated. They were in states that they could have operated, but they did have a reduction in the number of hours that they had people work because demand was down a little bit, right? So even though they weren't closed, because everybody else was being impacted, the demand for their goods or services was down a little bit. And so they right-sized the ship a little bit. And so as a result of that, they are still going to need to apply the test, so this is how they would apply that test. Now, I do want to cover how full-time equivalents are calculated. There are two methods. Full-time equivalents are deemed 40 hours a week. And so if you have a part-time employee, so somebody that works less than 40 hours, you can either use their actual hours divided by 40 to get their FTE, a full-time equivalent, for that part-time employee, or you can use a simplified method and just assign each part-time employee a 0.5 equivalent. And so if that's the case, then you have to apply whichever method you use consistently to determine it on a pay period by pay period basis, and also when you're determining your base period for the use in the benchmark period here. So those are the basics of forgiveness. I know we went through a lot there, but hopefully a lot of you are going to be able to take advantage of the easy form. And I want to close our presentation focusing on that. So there are two loan applications out there now. The first one is the normal application, which we thought was going to be the only application, but fortunately we did get an easy form. The easy form can be used if you meet one of three criteria. The first one will be if you're self-employed and you have no employees. So think about Schedule C folks without employees, independent contractors. All of those individuals now are going to be able to use the easy form, and they will be able to get 100% of their loan forgiven. Now, if you're a company though, and you had no wage reduction in excess of 25% and no reduction in the number of employees or the average paid hours from January 1st through the end of your covered period, you no longer have to, you can say, okay, I've met that safe harbor, therefore I can use the easy form. Now, we don't expect a lot of clients to be able to take advantage of that one because you are going to have fluctuations and you have to maintain, hours and employees during the entire covered period and going back to January 1st in order to meet the safe harbor. And so as a result of that, we don't think a lot of companies are going to meet this one, but some might be able to, particularly those that weren't impacted, that adversely and maintain their workforce during, the entire year so far. However, the last item on here, if you had no wage reduction in excess of 25% and you met that new safe harbor that you were unable to operate at the same level of business activity, then you can use the easy form. And in that case, you will not have any reductions to your payroll costs or anything. You'll just report your payroll costs, you'll report your loan amount, you'll report your payroll as a percentage of forgiveness. And as long as those numbers are all in excess of your loan amount, you'll be able to get forgiveness for that. So I do want to just wrap up with that there are a lot of great resources out there. The Treasury website and the SBA website continually have things that come out. I encourage you to go there. CLA's resource page is also a good one. We have weekly live streams. We'll be doing one tomorrow at 3 p.m. Eastern time or noon Pacific that we'd love to have you come to. And I know Banner Bank also has a great resource page that you should refer to. Here are some contact information for myself and some of the CLA folks on the call as well that have been fielding questions in the chat, as well as for your bank representatives that are likely working with a lot of you on the call. And so with that, I'll turn it over to Mark to bring us home today. Mark, you may still be on mute.
very much.
There you go.
All of us at Banner Bank would like to take this opportunity to thank all of you who joined the webinar today for your time and patience working with us through this event. We want to especially thank CliftonLarsonAllen and Jack for his presentation today. We suspect that changes will continue to be forthcoming. The information provided today is the best that we think we have, given the elements that are out there and given the continued changes and guidance that comes out. Please understand that we will continue to be a resource for you during this time, and we'll do our very best to get you the best information that we possibly can. In the next coming days, you will receive an email that will let you know how to access the slides, as well as how to access the recording of this webinar. As you can see, as I said, changes continue to happen. Please do not hesitate to reach out to any of us at Banner Bank, your partner at Banner Bank, myself, Steve, anybody at CliftonLarsonAllen that can support you through this process. Obviously, we believe, and they have demonstrated, that CLA has exceptional knowledge in this area. If you believe CLA can help you now or sometime in the future, or can be a benefit to your organization, we certainly would support you and suggest that you reach out to CLA and let them show you how they can support you and provide you what you need. Again, thank you very much for attending today. We wish you the very best during this time. Stay safe, stay healthy. Thank you. This concludes the meeting today, and I will turn it back to Becky or whomever needs to close it out.
Thank you, Mark.